Hey folks, welcome back to Personal Economics, your go-to source for straight talk on the economy that hits home for everyday Americans. Today, we're diving deep into a trend that's shaping our financial world right now, the K-shaped economy. If you've been scratching your head wondering why the stock market's booming while your grocery bill feels like it's on steroids, this is the video for you. We're talking about how the rich are getting richer and spending like there's no tomorrow, while folks at the bottom are tightening their belts just to get by. Let's break it down, step by step, with the latest data and what it means for you. First off, what the heck is a K-shaped economy? Picture the letter K. The upper arm is shooting up, that's the high-income crowd, seeing their incomes rise, their investments soar, and their spending keep the economy humming in certain sectors. The lower arm? It's dipping down, that's lower-income households, dealing with stagnant wages, rising costs, and a real squeeze on their budgets. This isn't some abstract theory, it's playing out in real time across America in 2025. Economists have been buzzing about this divide since the pandemic, but it's gotten sharper this year amid sluggish hiring, persistent inflation, and a job market that's cooling faster for some than others. Let's look at the numbers to make this concrete. According to recent data from Bank of America, based on their credit and debit card transactions, spending by higher income households jumped 2.7% in October 2025 compared to the same month last year. But for lower income groups? It barely budged, up just 0.7%. That's a stark gap. Overall consumer spending is still rising, but it's being driven almost entirely by the top earners. Meanwhile, Americans as a whole are feeling less confident about the economy. Surveys show confidence dipping even as growth chugs along at around 1.6% GDP in the first half of the year. Why is this happening? Blame it on a mix of factors. Inflation's been a killer for the bottom rung. Sure, it's cooled from its peaks, but prices for essentials like food, housing, and utilities are still way up from pre-2021 levels. Real wages, that's your pay adjusted for inflation, grew faster for low-wage workers in 2023 and 2024, at about 3.9% annually versus 3.1% for the top quarter. That helped close the gap a bit back then. But in 2025, as hiring slowed, that wage growth has weakened, hitting lower-income folks hardest. They're the ones who can't absorb a 20% hike in grocery costs without cutting back elsewhere. On the flip side, the wealthy are riding high on asset inflation. Think stocks, real estate, and even crypto. The S&P 500's been on a tear, fueled by AI hype and big tech investments. Bank of America estimates that giants like Microsoft, Amazon, Meta, and Alphabet poured $344 billion into capital expenditures this year. That's about 1.1% of the entire US GDP. Half of our economic growth in the first half of 2025 came from AI-related spending alone, according to Barclays. If you're in tech, finance, or own a bunch of shares, you're golden. Your wealth is swelling, and you're out there spending on vacations, luxury goods, and services that keep those sectors booming. But for the rest? It's a different story. A Federal Reserve Bank of Boston study from August found that consumer spending lately has been propped up by richer households, while middle and low-income Americans are racking up more credit card debt just to maintain their lifestyles, and even then, they're spending less. Bank of America's own institute reported that 24% of U.S. households are living paycheck to paycheck in 2025. That's 1 in 4 families with zero buffer for emergencies. Higher income and lower income folks are basically in two different economies, as one economist put it. Take holiday spending as a prime example. This Christmas season, the wealthy are driving the surge in online sales and discretionary stuff like travel and entertainment. Black Friday 2025 saw record online hauls, but a lot of that's from affluent shoppers. Meanwhile, lower income consumers are holding back, focusing on necessities or hunting for deals. It's a K-shaped holiday, the top arm indulging, the bottom scraping by, and with Trump's policies in play, think tariffs and fiscal uncertainty, that could push prices even higher, hitting the bottom harder. Now, let's talk jobs, because that's where the rubber meets the road. The unemployment rate's ticked up to its highest since 2005 in some metrics, with about 8 million out of work and another 5 million discouraged from even looking. Hiring sluggish, especially in sectors like retail and manufacturing that employ a lot of lower-wage workers. AI's booming, creating jobs in data centers and tech, but those gigs often require skills or education that not everyone has. Factories are stalling while AI-related construction soars. It's like two job markets, one thriving for the educated elite, another drying up for everyone else. Commercial real estate tells a similar tale. Office vacancies are climbing in secondary markets, putting pressure on lenders and owners. That's bad news for small businesses and regional economies. Credit flows are getting picky too, venture capital's chasing AI and green tech, but startups in other areas can't get funding. Banks are tightening loans to smaller firms. If you're a high earner in a gateway city like New York or San Francisco, you're fine. But in the heartland? Not so much. So, is this sustainable? Wall Street's on edge about it. Bank of America says the divide might not crash the economy right away. Their senior economist thinks the bottom of the K could stabilize before the top collapses, maybe through Fed rate cuts or policy tweaks. They're forecasting 2.4% GDP growth in 2026 and no recession. But others aren't so sure. Goldman Sachs sees a 20 to 25% chance of unemployment jumping half a point in the next 6 months. If job losses pile up among low-income workers, that could drag down spending even more, creating a vicious cycle. Delinquencies are another red flag. Credit card charge-offs are hovering around 2.98% as of September 2025, and they're rising faster for those with low credit scores. People are falling behind on bills because paychecks aren't keeping up with prices, especially now that inflation's ticked back up a bit. It's not just numbers, it's real stories. Think of someone like Austin from the reports, working in construction, living paycheck to paycheck, and facing layoffs with no safety net. Multiply that by millions, and you've got the bottom of the K. This inequality isn't new, it's been building for decades, but the K-shape amplifies it. The stock market's rewarding the well-off, with big tech lifting indexes while other sectors lag. Trump's approval on the economy's taken a hit because of this. People feel the pain even if headlines say growth is okay. Surveys show 28% of Americans see inflation as their top issue, 13% say jobs. And with the government shutdown earlier this year messing up data and confidence, it's all adding fuel to the fire. Looking ahead to 2026, Bank of America's global research sees stronger than expected growth, but with volatility from AI, deficits, and policy shifts. They highlight K-shaped consumption dynamics and jobless growth in the US. The Fed might cut rates 25 basis points in December 2025 and twice more next year, which could help ease borrowing costs for everyone. But if tariffs kick in harder, that could spike inflation again, hurting the bottom even more. What does this mean for you? If you're in the upper arm, keep investing wisely, diversify beyond tech to hedge against a top collapse. For those in the lower arm, focus on building skills for in-demand jobs, like AI or renewables. Cut unnecessary spending, build an emergency fund if possible, and watch for government aid programs. Advocacy matters too, push for policies that boost wages and affordability. In the end, this K-shaped reality is a wake-up call. America's economy is strong on paper, but it's leaving too many behind. If we don't address the divide, through better wage growth, affordable housing, or retraining programs, it could tip us into recession. Stay informed, folks, knowledge is power in these uneven times. If this hit home, like, subscribe, and drop a comment. Are you feeling the K-shape in your wallet? We'll cover more next time. Thanks for watching.